If you are 65 or older and your policy has a death benefit of $100,000 or more, there is a good chance you can sell it. You do not have to be sick, and there is no new medical exam. That is the short version. Underneath it, buyers are measuring one thing that explains every rule on the list. Here's what buyers check first: whether your health has to be bad, which policy types can actually be sold, and the 5 things that disqualify a policy. Buyers weigh 3 things above all: the insured's age, the size of the policy, and the policy type. Age comes first. Most buyers look for an insured who is 65 or older. There is no upper age limit, and offers generally strengthen with age, so policyholders in their 70s, 80s, and 90s often draw the strongest interest. Size comes next. Most buyers set a minimum death benefit of $100,000, and policies of $250,000 or more attract the most competitive bidding. One requirement sits behind both. The policy usually needs to have been in force about 2 years, which matches the contestability period written into most policies. If yours is newer than that, the answer is usually wait, not never. Here's the part most people get wrong. You do not need to be ill to qualify, and many policies qualify on age and size alone. But underneath the age rule, what buyers are actually pricing is life expectancy, generally 15 years or less. That one number explains the rest of the checklist. It is why offers strengthen with age, and it is why a change in health since your policy was issued, even a manageable condition like diabetes or heart disease, tends to raise what your policy is worth rather than lower it. It runs the other way too. An insured under 65 with a serious or chronic condition can qualify, usually as a viatical settlement, and nobody re-examines you. Buyers underwrite for medical records you already have, which is why the paperwork includes a records release and not an exam appointment. Now the policy type. Universal life is the most frequently sold policy in this market, and that includes indexed, guaranteed, and variable universal life, along with survivorship policies covering 2 people. Whole life can be sold as well, though fixed premiums and a large loan or high cash value make it harder to place. Term is where it gets specific. Standard term with no conversion option usually cannot be sold because there is no permanent death benefit for a buyer to take over. Term with a conversion right is a different story. It can be converted to permanent coverage, usually with no new medical exam, and then sold. So the conversion deadline in your contract is the date that matters. Ownership is flexible too. A policy held by a trust or a company can be sold when the trustee or the officers have authority to sell it, and an outstanding policy loan does not disqualify you. It is paid off from the proceeds at closing. Last, the honest side. 5 things account for most disqualifications: an insured under 65 with no change in health, a death benefit under $100,000, a policy in force less than about 2 years, standard term whose conversion window has already closed, and a cash surrender value that has grown close to the death benefit because a buyer has little room to beat what your insurer already pays. That last one deserves saying plainly. Surrendering is sometimes the better deal, and a broker who represents you should tell you when that is true. Keeping the policy can be the right answer as well. If your family still needs the coverage and the premiums are manageable, that beats any offer. You do not need to check every box on this list. If the first 3 describe you, it is worth asking. Citizens Life Group put this explainer together. If you want a number for your own policy, the estimate link is in the description. There is no upfront cost.